The global economy rests on a profound, terrifying illusion, an illusion that is quietly destroying the financial future of millions of hardworking people every single day. If you have cash sitting in a bank account right now, you believe you are being responsible. You believe you are storing safety, security, and liquid wealth for your family. But beneath the surface of the modern financial system, a silent engine is draining your purchasing power with mathematical precision. You are not holding wealth. You are holding a decaying promissory note issued by a system engineered to dilute its value. To understand why cash is a guaranteed trap, consider two people living in the exact same neighborhood. Meet Julian. Julian is 42 years old, earns a high executive salary of $350,000 a year, and prides himself on playing by the rules. Julian works long hours, pays his taxes, and saves every dollar he can. Right now, he has $600,000 parked neatly across high-yield savings accounts and money market funds. He looks at his bank balance and feels a profound sense of security. He believes he has built an impenetrable financial fortress. Then meet Marcus. Marcus is 45 years old, owns several private enterprises and real estate assets, and keeps virtually zero cash in commercial bank accounts. On paper, Marcus holds less cash liquidity than a junior employee at Julian's firm. Yet Marcus grows wealthier every month, pays a fraction of Julian's tax rate, and enjoys complete immunity from the hidden tax of inflation. Julian believes cash is wealth. Marcus understands that cash is merely a temporary medium of exchange, a depreciating token designed to be spent or converted immediately into productive assets. To see how Julian is being systematically impoverished while Marcus prospers, we must pull back the curtain on the fundamental mechanics of modern paper currency. Most people assume that paper dollars possess intrinsic value, backed by the output or reserves of a nation. But that reality vanished decades ago. In August of 1971, President Richard Nixon announced the temporary suspension of the direct convertibility of the United States dollar into gold. With a single official decree, the anchor tying paper currency to physical reality was severed forever. The world entered an unprecedented era of pure fiat currency, money created entirely by government decree and financial institution balance sheets. Without a gold standard, there was no physical limit to how many dollars could be created. Central banks and commercial lending institutions gained the legal authority to expand the monetary supply at will. When a bank issues a mortgage or a corporate credit line, it does not lend out physical cash sitting in a vault. It creates brand new currency digitally on its ledger. Every new dollar created instantly dilutes the value of every existing dollar already in circulation. Consider what happened between the year 2020 and the year 2022. In response to global market panics, the Federal Reserve and world central banks printed trillions of dollars out of thin air. Over 40% of all United States dollars in existence were created in a span of less than 30 months. Imagine a company with 1 million shares of stock suddenly issuing 400,000 brand new shares without adding any new factories or revenue. The value of every original share drops. That exact process happened to every bank account in America. When central banks flooded the global financial system with fresh liquidity, those new dollars did not sit idle. They chased goods, services, physical land, energy, and corporate equity. This created the massive inflationary wave that shocked global consumers. Julian watched prices rise at grocery stores, gas stations, and home listings. His $600,000 in savings did not decrease in numerical count. The digital bank balance still displayed $600,000. But the actual purchasing power of those dollars collapsed by over 20% in real terms. While Julian felt safe looking at his static balance, he had effectively lost over $120,000 of real human labor power. Here is where the financial trap deepens. Julian attempted to protect himself by moving his savings into high-yield savings accounts paying 5% annual interest. He calculated that 5% on $600,000 would yield $30,000 in passive income. He thought he was beating the system. What Julian failed to realize is that high-yield interest is classified by the Internal Revenue Service as ordinary income. Because Julian earns a high primary salary of $350,000, his marginal income tax rate sits near 37%. Out of his $30,000 in interest gains, the government takes nearly $11,100 in taxes. Julian is left with $19,900. Meanwhile, true real-world inflation, measured not by the sanitized government consumer price index, but by the actual cost of living, housing, healthcare, and quality assets, expanded by 7%. While Julian earned a net return of 3.3% after taxes, the cost of living rose by 7%. Julian did not make money. He suffered a net real loss of nearly 4% on his entire life savings. He paid the government for the privilege of losing purchasing power. Marcus, on the other hand, operates under an entirely different financial framework. Marcus knows that when central banks print trillions of new dollars, those dollars flow directly into hard assets. Instead of holding $600,000 in a bank account, Marcus used institutional leverage to acquire cash, flowing commercial real estate and equities. When the monetary supply expanded by 40%, the price of Marcus's land and corporate shares surged upward in paper dollar terms. His net worth expanded alongside the currency expansion. Furthermore, Marcus backed his asset purchases with fixed-rate debt. This is the ultimate system secret that Marcus exploits. When the government inflates the currency, paper dollars lose value, but fixed debt obligations stay numerical constant. Marcus borrows $10 million in 1971 or 2020 dollars and repays that debt years later with heavily diluted, far less valuable future dollars. Inflation actively destroys Julian's cash savings while simultaneously wiping out the real value of Marcus's debt obligations. The financial system is mathematically structured to reward borrowers of hard assets and penalize holders of fiat cash. The middle class is taught to work hard, save money, and avoid debt. The ultra-wealthy are taught to borrow money by appreciating assets and avoid cash. This structural dynamic is not an accident. It is the core operating mechanism of modern monetary policy. To fully grasp why this machine functions the way it does, we must examine the hidden mechanics of central bank balance sheets, fractional reserve multiplication, and the velocity of capital. When commercial banks receive a cash deposit from a retail customer like Julian, they do not hold that money in safety. Under fractional reserve regulations and modern liquidity requirements, banks use that deposit as a foundation to issue multiple loans out into the economy. When Julian deposits his $600,000, the bank uses that capital reserve to issue over $5 million in new commercial debt, auto loans, and mortgages to other borrowers. The bank charges those borrowers 7, 8, or 9% interest while paying Julian a fraction of a percent in traditional savings or 5% in temporary promotional accounts. The bank multiplies Julian's cash reserve to generate massive interest spreads for its shareholders, while leaving Julian exposed to the full brunt of monetary debasement. Furthermore, the government measures inflation using the Consumer Price Index, a metric carefully adjusted using substitution, geometric weighting, and hedonic adjustments. When beef prices skyrocket, the index substitutes chicken. When housing costs surge, the index uses owners' equivalent rent rather than actual home purchase prices. The official inflation metric is designed to understate the true decline of paper currency, keeping ordinary citizens like Julian convinced that their savings are maintaining value. While Julian relies on official government figures, Marcus looks at the M2 money supply growth rate. The M2 money supply tracks total liquid currency in circulation, including cash, checking deposits, and money market funds. Over the past 50 years, the M2 money supply in the United States has expanded at an average rate of approximately 7 to 8% per year. This 8% annual growth rate represents the true baseline benchmark for capital preservation. If your wealth is not growing by at least 8% every single year after taxes, you are not accumulating wealth. You are slowly drowning in diluted currency. Julian's 5% bank yield, taxed at 37%, gives him a real return of 3.3%. Against an 8% monetary expansion rate, Julian is losing nearly 5% of his real wealth every single year. In 10 years, Julian's $600,000 will buy half of what it buys today, even though his digital bank statement will show the exact same number. This is the quiet tragedy of modern finance. Julian spent decades working long hours, trading his finite human time for paper dollars, only to store those dollars in a vessel engineered to leak value silently every day. Marcus avoids this trap by converting every excess paper dollar into productive capital engines as quickly as it arrives. He treats fiat currency as a hot potato, a decaying medium that must be passed off immediately in exchange for assets that possess pricing power. Pricing power is the ability of a business or asset to raise its prices in line with inflation without losing customers. When the cost of energy, labor, and materials rises, a well-managed company raises the price of its products. Its revenues expand alongside inflation, protecting its underlying equity value. By holding corporate equity and physical land, Marcus owns assets that automatically adjust upward during periods of monetary expansion. When Marcus receives capital, whether from business distributions or real estate cash flow, it never sits idle in a standard commercial checking account for more than 48 hours. Marcus operates on a fundamental principle known in institutional finance as the velocity of money. To understand why Marcus moves capital so rapidly, we must analyze a concept formulated in the 18th century by economist Richard Cantillon, known today as the Cantillon Effect. When a central bank creates new digital currency, that fresh money does not distribute evenly or simultaneously across the entire economy. It enters the financial system at specific injection points through primary dealer banks, corporate debt markets, government contractors, and institutional asset management firms. The entities standing closest to the central bank's money printer receive those newly created dollars first, long before prices across the broader real economy have adjusted upward. They use this fresh, uninflated capital to purchase real estate, corporate equity, energy infrastructure, and commodities at current depressed market prices. By the time those newly printed trillions trickle down through multiple layers of the banking ecosystem to reach ordinary wage earners like Julian, consumer prices have already skyrocketed. Julian receives his inflated wage at the very bottom of the distribution chain, paying higher prices for food, housing, and energy with currency that has already lost its purchasing power. Marcus positions himself at the top of the Cantillon cascade. Instead of waiting for currency to trickle down to him as a wage, Marcus owns the asset structures that absorb institutional capital injection directly. Let us look closely at how Julian's financial life cycle operates compared to Marcus. Julian works 60 hours a week at a corporate firm to earn his $350,000 salary. Before his paycheck even arrives in his bank account, federal and state governments withhold over $120,000 in income and payroll taxes. Julian takes his remaining $230,000 of net income and pays his living expenses, mortgage, and auto loans. He is left with approximately $80,000 in surplus cash at the end of the year. He deposits that surplus directly into a bank account or money market fund earning 5% interest. As established, that 5% interest is taxed again at his top marginal tax rate of 37%, leaving him with 3.3%. Meanwhile, the true monetary expansion rate of 8% continues to erode the purchasing power of his remaining principal. Julian is stuck on an exhausting treadmill, working harder every year just to keep his real wealth from collapsing. Marcus breaks this cycle entirely by executing a two-part institutional wealth strategy: asset-backed borrowing and tax-sheltered capital recycling. When Marcus acquires a commercial real estate property or a basket of cash-flowing business equity worth $5 million, he does not pay for it with saved cash. He uses an institutional debt facility. Over a 5-year period, as the central bank expands the M2 money supply by 8% annually, the paper dollar valuation of Marcus's property rises from $5 million to $7 million. At the same time, the rental income generated by the tenants increases alongside inflation. Marcus now sits on $2 million of equity gains. If Julian owned that asset and wanted to access that $2 million, he would sell the property, trigger a capital gains tax event, and surrender hundreds of thousands of dollars to the government. Marcus never sells. Instead, he approaches an institutional private lender and secures a cash-out refinance loan or a securities-backed line of credit against his property equity. The bank lends Marcus $1,500,000 in liquid cash, using his property as collateral. Here is the ultimate structural breakthrough that separates the ultra-wealthy from the middle class. Under the United States Internal Revenue Code, borrowed capital is not classified as income. Money received from a loan or a credit line is considered a financial liability, not taxable earnings. Marcus receives $1,500,000 in cold, hard liquidity directly into his account. He pays $0 in federal income tax, $0 in state income tax, and $0 in capital gains tax. While Julian works 2,000 hours a year to generate $350,000 of heavily taxed salary, Marcus generates $1,500,000 of completely tax-free liquidity with a single loan execution. Marcus then takes that $1,500,000 of non-taxable cash and immediately deploys it to acquire another income-producing asset, a multi-family residential building generating 6% net rental yields. The rental income from the new building pays off the interest on his loan, while the underlying property continues to appreciate as currency debasement accelerates. This is the self-reinforcing wealth engine used by family offices and institutional investors. Marcus converts depreciating fiat currency into appreciating real assets, uses those assets as collateral to borrow tax-free liquidity, uses that liquidity to acquire more real assets, and lets inflation erode the real burden of his debt over time. Julian remains trapped because he was conditioned by traditional financial culture to believe that debt is inherently dangerous and cash is inherently safe. He views debt through the narrow lens of consumer liabilities, credit cards, auto loans, and personal debt used to purchase depreciating consumer goods. Julian does not distinguish between consumer debt, which drains personal cash flow, and institutional asset debt, which captures monetary expansion and creates tax-sheltered liquidity. By avoiding all debt indiscriminately, Julian deprives himself of the primary mechanism used by the top 1% to hedge against monetary debasement. To see the full scale of this disparity, let us calculate what happens to Julian and Marcus over a 15-year timeline. Julian continues to save $50,000 a year in cash, depositing it into bank accounts and low-yield instruments. Over 15 years, he deposits $750,000 of his hard-earned savings. With compounding interest minus taxes and inflation, his total real purchasing power actually declines by nearly 25%. He worked 15 years to become relatively poorer. Marcus, operating with the exact same initial starting capital, compounds his real asset portfolio through continuous collateral leverage and capital recycling. At the end of 15 years, his real asset holdings have expanded fourfold, his rental cash flow has tripled, and his debt burden has been heavily diminished in real purchasing power terms by relentless currency expansion. The difference between Julian and Marcus is not talent, intelligence, or work ethic. It is structural positioning within the architecture of the financial system. To understand how any investor can transition out of Julian's cash trap and into Marcus's asset engine, we must break down the exact three-stage capital allocation framework used by private wealth managers. This three-stage framework begins with a complete re-engineering of how liquid reserves are defined and managed. Stage 1 is the elimination of stagnant cash buffers. Traditional financial planners tell corporate employees like Julian to maintain 6 to 12 months of living expenses in standard checking or savings accounts. For Julian, whose household expenses run $15,000 a month, this means keeping nearly $200,000 in cash as an emergency fund. Julian believes this $200,000 provides absolute safety. In reality, that money sits in a commercial bank balance sheet, earning a nominal interest rate that fails to keep pace with real monetary expansion. Every single year, Julian's emergency fund loses roughly $10,000 to $16,000 in real purchasing power. Marcus approaches liquidity through a completely different structural model. Marcus maintains a minimal cash buffer, exactly 30 days of operational working capital. The remaining $200,000 that Julian keeps in cash is placed by Marcus into Tier 1 institutional liquidity instruments. These instruments include ultra-short duration treasury bill ladders, sovereign liquidity funds, and revolving asset-backed credit facilities. By utilizing a revolving credit line secured by his investment portfolio, Marcus gains access to instant borrowing power at wholesale prime rates whenever an emergency or investment opportunity arises. Marcus does not hold cash for emergencies. He holds borrowing capacity. He pays zero interest on his credit line until he actually draws down capital. While Julian's cash buffer decays every day in a savings account, Marcus's liquidity buffer stays fully invested in cash-flowing real assets until the precise moment capital is needed. This brings us to stage 2 of the institutional capital framework: hard asset velocity and pricing power alignment. Once working liquidity is optimized, every excess dollar of cash flow generated by Marcus's businesses or investments is immediately channeled into hard assets with high pricing power. Pricing power is the master metric that separates elite investments from speculative traps. When inflation surges, ordinary companies with weak pricing power see their input costs rise while their profit margins collapse. They cannot raise prices on consumers without destroying demand. Their stock valuations plummet in real terms. Marcus avoids these weak companies entirely. He allocates capital into two specific categories of pricing power assets: essential infrastructure real estate and high-margin corporate enterprises with monopolistic moats. Consider a multi-family residential complex in a high-growth metropolitan area. Housing is a non-negotiable human need. As the Federal Reserve expands the currency supply, wages and consumer prices rise across the economy. Marcus raises apartment rents annually in direct proportion to monetary expansion. Because Marcus holds a fixed-rate 30-year mortgage on the property, his debt service payment remains frozen in nominal dollar terms. As rent revenue expands by 8% per year, his net operating income surges at an exponential rate. The asset automatically captures monetary inflation and converts it directly into higher net cash flow for Marcus. The third and final stage of the capital allocation framework is the execution of perpetual tax-sheltered compounding, utilizing statutory tax provisions written specifically for capital owners. To understand how Marcus legally eliminates income tax while compounding millions, we must look at the legal mechanics of depreciation and exchange protocols under the Internal Revenue Code. When Julian earns $350,000 in salary, every dollar is taxed immediately at ordinary income rates. He has zero legal mechanisms to offset his W-2 salary income. When Marcus receives $500,000 in rental revenue from his commercial real estate portfolio, he executes a cost segregation study. A cost segregation study allows a property owner to reclassify building components, such as lighting, carpet, specialized plumbing, and paving, into accelerated 5-year, 7-year, and 15-year depreciation schedules. Under bonus depreciation rules, Marcus writes off hundreds of thousands of dollars in paper asset depreciation against his gross rental income in year 1. On paper, the Internal Revenue Service sees a net operating tax loss of $200,000. In physical reality, Marcus collected $500,000 of positive cash flow. Marcus pays $0 in current income tax on his real estate earnings. He takes that tax-free cash flow and reinvests it into new productive assets before the end of the tax year. Furthermore, when Marcus eventually decides to pivot out of one real estate asset and into a larger commercial enterprise, he never pays capital gains tax. He utilizes a Section 1031 tax-deferred exchange. Under Section 1031 of the tax code, an investor can sell a real estate asset, roll the entire proceeds into a new like-kind property of equal or greater value within 180 days, and defer 100% of capital gains and depreciation recapture taxes indefinitely. Marcus repeats this process over his entire lifetime, acquiring assets, refinancing them to extract non-taxable debt liquidity, executing cost segregation studies to eliminate income tax, and using Section 1031 exchanges to roll equity forward tax-free. When Marcus reaches the end of his life, the final statutory mechanism executes automatically. Section 1014 Step-up in basis. Under Section 1014, when Marcus passes his asset portfolio to his heirs inside an irrevocable trust structure, the tax basis of all his assets is stepped up to current fair market value. All accumulated capital gains from 40 years of real estate appreciation are legally wiped out to $0. His heirs inherit a $20 million asset stack with zero deferred tax liabilities. They can immediately sell those assets at market value and pay $0 in capital gains tax, or continue borrowing against them to fund their lives tax-free. This is how family offices compound wealth across generations uninterrupted by the state. Julian works 40 years, pays 40% in taxes, holds cash, and loses half his remaining net worth to inflation and probate. Marcus builds a perpetual capital engine that pays zero taxes, borrows against appreciating equity, and transfers wealth seamlessly to the next generation. The choice facing every investor today is simple: remain in Julian's paradigm of cash accumulation and currency decay, or transition into Marcus's framework of asset ownership, collateralized liquidity, and structural wealth preservation. To execute this transition in physical reality, one must first abandon the psychological comfort of paper balances and adopt an institutional balance sheet mindset. The shift begins with a comprehensive audit of all liquid holdings. An investor operating under Julian's old model looks at a $600,000 bank balance and sees safety. An investor transitioning into Marcus's framework looks at that same $600,000 and sees a decaying liability losing value every single hour. The first tactical action is setting an absolute ceiling on uninvested cash. Operating capital should be strictly capped at 30 to 60 days of actual living or business expenses. Every dollar above that operational ceiling is capital exposed to systemic erosion. For Julian, capping his liquid bank reserves at $30,000 frees up $570,000 of stagnant liquidity. Rather than dumping that $570,000 blindly into high volatility markets or speculative retail stocks, the institutional playbook dictates establishing a layered capital deployment engine. Layer 1 of this engine is the establishment of a credit-backed liquidity mode. By placing a portion of capital into ultra-short duration government debt or investment-grade liquid instruments, Julian can establish a portfolio line of credit or securities-backed line of credit through an institutional broker. This provides Julian with a $300,000 revolving credit line accessible within 24 hours. Should an emergency or an urgent life expense arise, Julian borrows against his liquid securities at low institutional interest rates, leaving his underlying principal untouched and compounding. He no longer needs $200,000 of cash rotting in a savings account to feel secure. Layer 2 is the deployment of remaining principal into income-producing hard assets with inherent debt-resilient pricing power. Julian deploys his remaining capital as down payment equity on cash-flowing commercial real estate or acquires shares in high-margin, dividend-growing enterprise monopolies. By pairing his equity deployment with fixed-rate long-term debt, Julian locks in borrowing costs in current dollars while acquiring assets that appreciate alongside monetary expansion. When central banks expand the M2 money supply by 8% per year, the market valuation of Julian's hard assets expands in paper dollar terms, while his fixed debt obligation remains completely static. Layer 3 is the integration of statutory tax optimization. By engaging a certified tax strategist to execute cost segregation studies and bonus depreciation schedules on his real estate acquisitions, Julian generates paper tax losses that offset his cash flow. For the first time in his career, Julian receives thousands of dollars in monthly cash flow without handing 37% of it over to the state. He stops trading his finite human time for ordinary W-2 income and begins building a self-sustaining corporate balance sheet. Understanding this transition is more urgent today than at any other point in modern financial history. The macroeconomic forces driving global monetary expansion are accelerating at an unprecedented rate. Sovereign governments across the globe face historically unprecedented national debt levels. With United States national debt exceeding $34 trillion and annual interest payments eclipsing $1 trillion, central banks face an inescapable mathematical reality. They cannot allow interest rates to remain high indefinitely without bankrupting sovereign treasuries, nor can they collect enough direct tax revenue to pay down $34 trillion in principal. The only mathematically viable escape route for sovereign nations is financial repression, keeping nominal interest rates below the true rate of monetary inflation to inflate away the real burden of government debt. This policy of deliberate currency dilution is a hidden tax levied directly on cash savings. Every time a government inflates its currency to service national debt, it is quietly transferring wealth from citizens who hold paper money to institutions that hold real assets and fixed debt. Furthermore, the impending rollout of central bank digital currencies gives monetary authorities unprecedented direct control over systemic liquidity. Programmatically tracked digital currencies allow central banks to execute negative interest rates, direct holding penalties, and targeted liquidity limits, making stagnant paper savings even more vulnerable to institutional extraction. Those who remain trapped in the conventional mindset of saving paper cash will watch their life's labor diluted into statistical insignificance over the coming decade. They will work longer hours, pay higher real living costs, and wonder why they're dedicated savings by less every single year. Those who master the mechanics of the system, who convert fiat currency into hard assets, utilize collateralized borrowing, and leverage statutory tax protections, will protect their families and build wealth that survives any economic environment. The money printer will not stop running. The expansion of the currency supply is an architectural requirement of a debt-based monetary system. You cannot change the rules of the macroeconomy, but you can change your position within the framework. Julian realized that his $600,000 in savings was not a fortress, it was a decaying vault. By shifting his capital out of paper promises and into productive, debt-leveraged assets, he stepped off the hamster wheel of currency debasement. Money is not paper currency. Paper currency is merely the claim check. Real money is the underlying land, the productive enterprises, the energy infrastructure, and the collateralized capital engines that generate real value regardless of what central banks print on a ledger. Stop holding the claim checks while institutions accumulate the real assets. Convert your paper currency into productive wealth before the system dilutes what you worked a lifetime to build.